Do you only want to sell your IFA business to an acquirer who has many years' experience of making over 100 acquisitions with the benefit of speaking with highly satisfied vendors that have gone through the process? Well, our client is a national independent financial planner and wealth manager who is actively seeking to acquire well-run and profitable IFA businesses with upwards of £200,000 of recurring income with no maximum, and will consider full or partial buyouts of larger IFA firms. They are highly profitable with revenue of £70 million and assets under management of £10 billion. They have over 150 advisors and over 600 staff in total, operating from just under 50 local offices nationwide. With the backing of a well-respected and well-funded mid-tier PE houses, plus a mainstream bank, they have funding in place to repeat last year's exceptional delivery of acquiring another 25 to 30 IFA firms per annum. Set up over 15 years ago with a view to consolidating the IFA market, they have many years' experience of completing over 100 acquisitions of IFA firms. They are considered one of the longest standing active national consolidators in the UK. The benefit of selling to a firm who have years of experience in acquisitions is that they have already been through the challenging period of integrating hub acquisitions, unlike many other peers who still have these challenges to come. With a ratio of support staff to advisors of just under 3 to 1, your clients will have a tent of advisors who are suitably qualified to provide advice in all areas of financial planning. Not all consolidators are the same, as our client is known to have a strong client-centric and compliance-focused culture, and all of their acquisitions must share their ethos and client-centric culture. Offering fully independent advice with open architecture, they utilize all major platforms and third-party DFMs. In addition, they also have a strong performing in-house discretionary portfolio management whose primary function is to reduce the regulatory risk, which is a highly cost-effective solution which performs well with an outstanding track record built over 10 years, delivering benchmark returns for clients across all risk profiles. There is no mandate or incentive for advisors to recommend their CIP, so clients will be pleased to know that they will not be shoehorned into expensive fee structures. They have 3 advice service propositions with starting percentages ranging from 0.5% to 1%, plus tiered rates as low as 0.25% for high value investment clients. They also offer a lower tariff for lower value clients who do not receive ongoing advice but do want the benefits of administration service and newsletters. Clients won't be shoehorned onto expensive platforms either, nor moved away from existing investment mandates unless it's in the client's best interests. Therefore, you have the confidence that acquisitions are non-contingent on making changes to expensive investment or charging structures. The exit options. There are typically 3 deal overviews available, but they can do a mixture of all 3 if there are shareholders wanting different exit routes. First of all, there's the immediate retirement. The vendor principal retires on completion. Clients are handed over to existing advisors in their local office. Consideration is paid out over a 2-year period. The office isn't kept on, but staff can be added to an existing location. The multiple of recurring income is generally between 3.5 to 4.5 times, and it's payable 50% up front, 25% at 12 months and 24 months. And the other option is transitional retirement. This is where the vendor principal remains as an advisor for a period, but with a view to retiring in the short to medium term. Clients are handed over to existing advisors on retirement. The majority of the consideration is paid out within the first year, with a final payment post-retirement and handover of clients. Staff can be kept on and added to an existing location if there is an office nearby, or if none locally, can retain the office and establish as a new location. These deals are normally paid on a normalised EBITDA basis of usually 7 to 8 times, payable 50% upfront on completion, 25% at 12 months, and the final 25% is paid 15 months after the advisor has deauthorised. The minimum salary that a vendor is required to take for EBITDA purposes is 20% of recurring income, but they can take more if needed. The next option is a partnership model, where the firm acquires, say, 60% and you retain 40%. This suits larger businesses, which retain staff and location office to become a hub. The deal works best when a vendor principal wants to grow the business as part of a national firm and benefit from the upside in the value of the retaining shareholding. This can be part of a longer transition to retirement. This model creates an opportunity to inherit local clients that are acquired from other retirement deals. How these deals are structured is that 60% will be paid out, 50% of the 60% upfront, followed by 2 deferred payments of 25% at 12 months and 25% at 24 months. The other 40% gets revalued and is paid out within 2 years of retirement or pre-agreed time frame. The upside of this partnership deal is the sharing the value from revenue and profit growth, where the remaining 40% could be worth double what it would have been initially. The office is generally always kept and established as a new location or hub. The consideration is valued as a normalized EBITDA and are typically a multiple of 7 to 8 times. Please note that corporate income will be included at the standard multiple as long as the bulk of the income is from fund management ongoing advisor fee income. Now, a recap on the benefits of selling to our clients are their vast experience. They have acquired over 100 financial advisory firms and they have a clear, tried and tested step-by-step acquisition process with an acquisition integration team of over 40 staff supporting the seamless delivery to migrate and retain clients. Their ethos is to deliver a client-centric, ethical approach. Your clients will be looked after to the same standard that you have done for many years. There is no requirement to move clients to a centralized investment proposition, as these can be left on open architecture. Clients can remain on existing charging structures, and there is flexibility on the frequency of review meetings. DB pension transfers will also be considered subject to due diligence. So, the IFA client bank criteria? Well, you should have a minimum recurring income of 200,000. But no deal is likely to be too large. With just under 50 offices nationwide, clients are likely to have a local office serving them. All locations are therefore considered nationwide. Call us now to find out more about how this exciting acquirer could meet your exit needs. And if these deals don't suit you or you don't suit them, we have over 200 other acquirers to consider, making sure it's the best deal for you. Our contact details and link to our website is shown below. If you're an IFA looking to retire, we recommend you subscribe to our newsletters and YouTube channel. We post informative and helpful videos which could benefit you.